Hi, welcome to Market Minute. This is where we analyze the markets, looking for opportunities where we can make some money, but also maybe as important to avoid losses. We think we're entering the tough periods, the tough months for the markets, meaning we're entering hurricane season. So much like the warm waters in Florida, which creates the environment for a hurricane, and generally we have those every year, the markets tend to be really tough in August, September, and sometimes it bleeds over into October. So why September is particularly negative? We believe it's the case because that's when the expectations of the market need to start to match the fundamentals. The markets are currently trading at 21 times earnings. That's high, very high. It's way at the upper end of the range. 21 times earnings on this year's 2023 earnings estimates. So the environment is right. The market's up quite a bit this year. The environment's right to have some problems in the markets, just like hurricane season. So the bullish sentiment is now at a high level. 70% on one survey we monitor, 2 to 1 on another survey, bulls the bear. So the environment is right, just as the water is very warm off the coast of Florida, the sentiment is very positive. So that means that the sentiment is right to have a storm occur in the markets in those vulnerable months of August, September, and perhaps October. Another thing that we look at is the CBOE volatility index. This is a good measure of a sentiment in the markets itself. So we're way down here at 13 on the volatility index. It does go lower, but not a whole lot lower. So that's a low level for volatility. It means that volatility is cheap in the markets. You can buy the VIX to protect yourself or to speculate on the markets dropping and not have to pay a lot of money for it. So the range in the volatility index is right around here, maybe 12 at the low end of the range, up to 60, 70, or 80 at the upper end of the range. So you can see we're at the very low end of the range. Usually when it's 40 at 40 or so, we're in a bear market. So looking at the technicals a little bit, the technicals are positive, nicely positive, above the 20-day, 50-day, 200-day moving averages. So it's to the point where it's so positive. We're 12.5% above the 200-day moving average. The 200-day moving average is in an uptrend, so that's good, but that's a significant distance from the 200-day. Most are, in our belief, most tactical managers view the 200-day as a line in the sand where they start to get defensive. That's the point where we want to be completely locked down, but I do it in increments before that. So if we break the 20-day here, I want to become more defensive or defensive in our portfolios to some degree. Break the 50-day a little bit more, and if we go through the 200-day, it could be completely locked down and totally defensive. So having a zero exposure in terms of beta versus the overall market. So that's quite a bit of difference between the typical tactical manager and us. They typically will wait for this large drop before they get defensive. I like to do it in increments before that. Earnings. So the fundamentals of the market, they're not real positive. The earnings estimates are coming in better than expected, but it's the old guide down before you report your earnings so you could beat on the upside. So you can see here it's not getting us too far. So $219 for the SP earnings. That's kind of basically where we've been recently. Not a big uptrend because the numbers came down. You can see that they've come down in a fairly meaningful manner before that has occurred, and the companies are beating those numbers by a little bit. Same way with 2024 earnings of $246. We're at, as I mentioned, 21 times earnings for this year, almost 19 times for next year. Those aren't great valuations. There's not a lot of momentum on the earnings. PEs are high, sentiment's high, so you can see the case for a hurricane possibly occurring. The environment's right for something to occur on the negative side in August and September where it traditionally has happened. Remember, it's statistically significant the negative effect of the September period in particular. So statistically, it stands out that for whatever reason, the markets tend to go down in September. And we believe because that's where you have to match the fundamentals with the actual performance of the markets at that point in time. This week we get Apple and Amazon reporting. Don't expect anything major out of either company. However, we are watching very closely any discussion about Amazon's artificial intelligence chip to compete with NVIDIA. I think that could be really interesting. So there could be another competitor coming into the market besides AMD versus NVIDIA. Employment is on Friday. This is something that it's kind of a complicated chart, and I'll walk you through this a little bit, but 200,000 new jobs is what is expected. Unemployment rate 3.6%. We don't see any major change in the jobs reports until there's a recession. And so what has historically happened, as you can see the red line here, this is the federal funds rate. It goes up, the unemployment rate doesn't do anything. So this is a little bit of frustration of the bears that they're not seeing any change in the employment reports to indicate that we're in a recession. It actually, as we go into a recession, then the employment reports get much more sketchy. Unemployment rates go up quite a bit. You can see this in the last two cycles that have occurred. Big increase in federal funds rate. Nothing happens, right? Boom, recession. That's where you get the break in the jobs numbers. So we had this massive increase in rates. Nothing happened on the employment report side. The unemployment rate stays steady, and then as you enter that recession, boom, you get a big uptick in the unemployment rate. So that's to come. Likely 12 months from now, we'll see a very significant change in the job market. Now we have a new buy stock to buy. Raytheon, so RTX. This is something I've been following for multiple decades. I love this company. Really well operated, really well positioned. They're in the growth markets in the aviation area and the military side. So the theme behind Raytheon is the Pentagon needs to reload, and Raytheon is the supplier. It's as simple as that. Raytheon has a huge backlog, 185 billion backlog, so great visibility of revenues going forward. The stock trades at 16 times earnings, which is a discount to the market at 21 times, and it traded 18 to 20 times recently, so it's at a discount to where it's traded with really good fundamentals. So what's brought this stock down is their latest earnings report. The latest earnings report was good. The Pratt Whitney division, their jet engine division, announced that they would have to have a recall of service on some jet engines that they have in the markets. Has no impact on the earnings. The stock reacted to it. This is a nice company to own. Let the fundamentals play out. So as the fundamentals play out, this stock will be meaningfully higher. So just remember, the conditions are right for a hurricane. We're entering the season that it occurs, August, September, and sometimes October. And just be careful. I have ways to protect our client portfolios against falling markets. It's time to be very aware of what's going on in the markets and that potential for a significant correction to occur during a seasonally consistent period in the markets that it does occur. Please hit like, subscribe, come on to my website, Patrick Adams CFA, and sign up for the hard copy of Market in a Minute. We'll send it to you every week. Take care.